Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, January 2024. S&P 500 at a number we haven't seen in over 2 years, 48.28. I'm David Zarling. I'm here with Ian, man of mystery, McMillan. Do all-time highs?
Fact, we've never once on this podcast have we started it off with a number above 48.28.
Correct. Like, this is new all-time highs.
2 years, technically, probably 2 years and 3 weeks. We'll call it 2 years for simplicity's sake. But yeah, December 2021 was the last time you can call it January 3rd, 2022. But yeah, a long time getting back to here, and we did not go in a straight line.
What?
It was a lot of angst, and
we didn't just go flat across, from January of 2022 from 48, let's call it 4,800 to now, which just wasn't
in the grand scheme, though, we can kind of look at this as a consolidation.
Yes, we can. I like where you're going with this.
Yeah, I mean, so Dow's already been at new highs. NASDAQ has already, been at new high. I mean, we kind of got there back in December. We've kind of piddled around here, but also new all-time highs for the NASDAQ today. I mean, there's very few things more bullish than all-time highs.
Yeah, can you talk about that concept? And the reason why I want to bring this up is, A, it's been that long, but B, there's also a behavioral aspect to this that is important to touch base on, that reaching a new all-time high has psychological or behavioral ramifications.
Hey, if you ever bought S&P before today, and you made money on it.
Right, yeah. So it's a new level.
It's a new level. Things are good.
Where sellers
from a technical perspective, there's nothing better than zero price history to the left. And you've got a clear line in the sand here. I think so.
Well, absolutely. You're saying that if our all-time previous daily closing high was 47.96 back on January 3rd of 2022, and now we're recording a new, we've got a little bit to close.
Mm-hmm.
But if we're recording that new high, we've never experienced this before, which means now sellers and buyers have a new dynamic. It's that relationship taking the next level.
Yeah, literally. I mean, literally next level. And you've got your line in the sand of, you look at S&P cash, let's call it 4,800. And you can say, okay, I am, the same way we used 4,180 and other levels that we've talked about on here for 4.5 years. As long as we're above here, I can be pretty bullish.
Well, and now you have to build new volume profile, or you have to build new interaction. It's almost like being around a new friend group, or there's new relationships that have to be built. If we're going to record this new high, it's now what technicians would call clear skies.
Yeah.
And so the interaction of supply and demand from that perspective hasn't seen these type of levels. It has in things like semiconductors and technology that have led the way. But if we're using S&P 500 as a proxy or a great representation of what's going on with U.S. markets, which S&P 500, let's be honest, one of the strongest indexes for the past 10 years, that's making new highs. That's tremendous information.
Yeah, I think obviously domestically, probably a bullish tailwind for the rest of the world. I assume they'll still underperform. But so the big theme so far, what we're 3 weeks into the year, is that a lot of continuation from themes we saw in 2023. So we spent the last few minutes talking about absolute highs, but new relative highs for NASDAQ, and you mentioned semiconductors, and just growth areas in general are, I know we had some small cap strength there at the end of 2023, but we seem to be picking back up with the growth theme.
Yeah, I think that's fair to highlight is in 2023, so coming out of which no one gets to argue about, the correction in 2022 from a broad index perspective, and I would argue the correction underneath the surface that actually lasted from 2021 into 2023, so a 2-year correction for a lot of stocks. Here we are, new era. You've got some relative relationships that are worth covering. And on an absolute basis, it's really hard to argue when you see things like semiconductors making new highs, technology making new highs. You said growth, right? Like when we look at growth stocks,
we're almost already at 3 weeks in, and the spread between growth and value is close to 4%.
What are you using for that? Are you using
SPYG and SPYV?
Okay. Yeah, that's a fair. I love that we can use relative relationships. Very quickly that changed by January 5th.
Yeah.
That there's been a blitzkrieg buying growth stocks from that point forward. Does that last? We don't know, but it's what's led in the past. Like that's what the largest cap means. For you. Say that again. I'm sorry, I missed that.
I mean, that's momentum for you.
Yes, momentum. Yes.
No one wants a bigger pool to play in than me. Would love for your average stock, small caps, yada yada, to come back into favor, but you're given the hand you're dealt.
And there's nothing wrong with Patrick Mahomes and the Josh Allens of the world leading their teams higher. The all-stars of their team, right? Your Microsoft, your Apple, your NVIDIA, the things that have led in the past, if they continue to lead, that's that concept of momentum. And there's nothing wrong with it.
Katie Stockton had a good, I think it was the chart of the day from the chart report yesterday, but she had a good, I think it was Microsoft and S&P or Microsoft and NASDAQ. It's Microsoft and S&P, and kind of looking at the patterns there on each. And to your point, the stronger, or as long as Microsoft stays strong, should bode pretty well. It's, tech is, how much are we up to in the S&P as far as the technology weighting?
You brought up Microsoft, and I think what's fascinating about this, what you just highlighted, is Microsoft is now the largest weighting in the S&P 500, around 7.3%. And it used to be Apple, but now it's Microsoft. But you asked the question about technology. It's almost 1/3. It's about 29%. Yeah. So crazy. 1/3 of the index is information technology.
We all know the stats. We all know about the Magnificent Seven, what it did for the market in 2023 versus the average stock. And, it was responsible for a majority of the gains. And yes, those are all statistical facts. But if your largest sector by far is
that's a good point to bring up,
the first to new highs and new relative highs, is that the worst thing?
When Ian says by far, what he's saying is, so technology in the S&P 500 is 29.5% of the S&P 500. The next closest sector is healthcare at 12.8. By far, it's double.
Yeah.
And so if your leaders continue to lead, who are we to argue with that?
And I think we're up to, we've got a few. I saw where NVIDIA is about to be larger than, obviously we know Apple, Microsoft, Amazon, all bigger than certain sectors, right?
Yep.
And I think we're close to, I saw this morning, reaching the fourth stock, NVIDIA.
Got to be close between it and Amazon. Like it's got to be neck and neck for the fourth largest.
And they're both close to eclipsing energy, which isn't even the smallest. Materials, the smallest, then utilities, then real estate. Those are all under 3%. And then you've got energy, the fourth smallest. And you've got these tech stocks that carry more weight.
So I got a question for you, and I've been thinking about this. So if I were to ask, I want to be careful because what I'm about to go down is not a testimony to anybody's intellectual power or anything of what they pay attention to. If I were to ask my spouse, my beautiful, wonderful Emily, does she know what Microsoft is? Yes. Has she heard of Apple? Yes. Has she heard of Google? Yes. Has she heard of Amazon? 100%. She's heard of Amazon. If I were to ask her what NVIDIA was,
Yeah.
do you know where I'm going with this?
Yeah, I don't think most people know what NVIDIA was. Like your average American, they would know what Facebook was. They would know what Tesla was.
Yes. Yes.
They know what JP Morgan is.
Yep.
But NVIDIA is
Berkshire Hathaway,
definitely
maybe.
not a household name. I'm sure there's some gamer dude that's listening to us that's like, oh, me and my girlfriend talk about NVIDIA chips all the time. That's awesome. I'm just saying that that's not.
Right. Like the NVIDIA name is not your household name. And here we have NVIDIA sitting borderline number 4 and waiting in the S&P 500. That's important information. And semiconductors, and we've talked about this in the past on previous episodes, right? Semiconductors are that one industry of the transportation of data.
Yeah.
Very important towards the risk on behavior of market participants. It's leading the way. We see semiconductors doing very, very well. It's a sub-industry or subsector of technology. These are healthy characteristics when you're seeing semiconductors on a relative basis moving to new highs for the S&P 500. And yet there's not this mass understanding. I will get nervous if Aunt Louise contacts me and says, I love NVIDIA. Like, she's not doing that.
No.
Like NVIDIA is not a household name it is from a market participant standpoint. Like you and I, and I'm guessing 95 to 99% of people listening to this know what NVIDIA is. But until it reaches a household name, there's might be more room to run here for something like NVIDIA. Could be.
Yeah, I mean, the chart says so too, so.
And how is that bearish? It can't be.
Cannot be.
And so you brought up growth versus value. That was a theme from 2023.
What about small caps? How are they doing, Dave?
Small caps still below important levels.
Yeah.
I mean, I want them. We've talked about this in the past. Like, hey, can we get out of the basement and get a job? I want small caps to be a bigger participant in this market. We're still sitting below levels that go back for almost a year and a half. From a volume weighted average perspective, we're sitting above the 2021 highs.
Okay.
That's a good thing.
That is good.
Now, do we have to wait until summer of 2024 to see small caps expand and that's what leads? I have no idea. But here we have tech, semiconductors, the things you want to see lead. I'm just being, I don't know if the right term is greedy, but if you were to see a broadening of participation and you saw small caps take the lead, I'm not opposed to that either. But that's not what's going on right now. We're not seeing small caps lead.
Yeah, that'll show up on a chart.
I like charts, Ian.
New route of lows for utilities.
Yeah, what do you mean by that? When you say
New route of lows for staples, bullish.
Yeah.
Materials, new route of lows. Yes, so I mean, people don't want to own this stuff. Well, they want to own less of it than they want to own the S&P as a whole.
Yeah, can you talk about that a little bit from a ratio perspective? Pretend that we have some people that are listening to this for the very first time. Hey, what is this ratio thing that you're talking about? You're talking about utilities versus S&P. You're talking about staples versus S&P. You're talking about like what does that mean when you're talking about that?
Just plotting one against the other. You got a denominator and a numerator like any other fraction, and you can visually plot which one is doing better. You know, if the chart's going higher, then the numerator is doing better. And if the chart's going lower, then the denominator is doing better.
So you're saying you'd rather see, from a risk-on perspective, something like Amazon do better than a Clorox?
Yeah, you don't want people buying staples and utilities. you don't want the demand for those sectors to be outpacing the demand for the market as a whole. Those are very defensive areas.
Mm-hmm.
Or you don't want them to be selling stocks, the broad market, more than they are selling, defensive areas.
Well, it's a good point. Like, okay, if the demand for Clorox stock outpaces the demand for Nvidia stock, like just that simple comparison would provide us information.
I'd say one of the bigger ones, new relative lows too, and these are like 18-month relative lows. Energy.
Oh,
Big breakdown this week and last.
That's a big one.
Yeah, I mean, that had been everyone's kind of, right? Early 2022.
Yep.
It was your outperformer. And it's definitely had some spurts since then as well. But breaking a big relative level there below I guess it's now a downward sloping 200-day.
Well, an important horizontal level on a relative standpoint, using something like XLE versus S&P, that's an important level.
Yep. And maybe it fails, and in a month, we're talking about a failed breakdown in energy and yada, yada. But until that happens, can't own it.
Right. And that goes back to like, what was a major narrative from last year? Inflation.
Yeah.
And inflation is driven by energy. And here you have energy from a stock perspective, looking at XLV versus S&P breaking down. So are we seeing disinflation or deflation in some of those things? That's important. These relationships matter. And so if you're going to have that breakdown, but you're going to have semiconductors move to new highs, you're going to have technology move to new highs, that's not a negative for the market. Like, that's important information. What else are we seeing when we think about relationships? We start out with growth versus value. You could argue mega cap or large cap versus small.
Oh, yeah.
What else are you seeing from a relationship standpoint? Because relationships matter, right? We're all like, let's not pretend people listening to
Foreign
this.
stocks are still brutal.
Okay, what do you mean by that? When you say that?
China's still brutal. Relative relationship downtrend. Yeah, China just is. I like how everyone was spooked. What was that yesterday when China was down like 3 or 4%? Was that yesterday?
Yeah, I mean, China's been in a downtrend when I say China's been in a downtrend, I'm not saying that in a vacuum. I'm saying, like, if you look at like the largest 50 versus the S&P.
Oh yeah, I mean, it hasn't participated in anything.
For a long time.
All these rallies we've seen since Halloween, maybe October 30th, technically, we bottomed. But around Halloween, and these things just continued to plummet.
Like, there's no need to grab a falling knife.
I mean, that might be one of the worst relative relationships in the entire world.
It's China.
Is China. That's a stock market, and even on an absolute basis, that is so if I look at, China large caps, yes, these are denominated in dollars. It is what it is. I don't want to hear comments on that. I use US dollars. So that's what we're going to talk about on this podcast. And so does Dan. So do our clients. So we're going to talk about things in terms of US dollars.
Wait, you buy stuff with dollars? Yeah, me too. That's weird.
People want to talk about go find a technical analysis podcast out of China. China is back to its 08 lows. You want to talk about a stock market that has not done anything. Has not done anything.
I mean, it's been a long time. I mean, you're talking about
16 years? Even
using FXI versus S&P, we're talking about massive new all-time lows. You use Asher, ASHR.
Yeah, what's Asher look like?
We're talking about lows that we haven't seen before. And again, Ian and I are not here to say that this isn't the bottom. It's just, here's the trend. And the trend in relative strength of China versus the US continues to be in a massive downtrend. And China just happens to be one of the larger weightings in emerging markets. And so when you look at emerging markets versus the United States, that's an issue because the industry says, oh, you should have some exposure to emerging markets. Well, if your largest piece of the pie for emerging markets is China, and that's, again, in 3 weeks, we could talk about exhaustion selling in China stocks and we're moving higher. That's definitely a possibility. At this point, China stocks are hands off.
So hands off.
Why hurt ourselves by trying to catch a falling knife? And there's other spots internationally that are working. They're not in a downtrend like China.
There's slots. Yeah, there are. I mean, they're really in a league of their own, which is fascinating for as large of a market. I mean, it's a liquid market. They're a large world market, obviously massive. I mean, we're talking about China here. And they just, again, it has to be one of the least attractive areas globally.
And isn't that so fascinating? Because I do feel like China for the last 5 years has been a dominant narrative or story or something that's popped up from time to time. And you just don't hear about Argentina. You don't hear about Latin America. You don't hear about Japan. Like, it's just interesting to note from a sentiment standpoint, a lot of focus on China, whereas you see some of these other relative strength areas, such as Japan or Latin America, that just doesn't seem to get the clicks or the views or the talking heads on CNBC. And that we do want to pay attention to it. And that's what makes technical analysis valuable is you can do these relationships and identify, hey, there's obviously something going on with Argentinian stocks, or there's something obviously going on with Japanese stocks or India stocks. I know you highlighted that in the
India, yeah.
And so we want to pay attention to these things.
And small cap India's got to be, yeah. They were at new all-time highs back in November.
So here we have an environment where semiconductors are leading us higher, tech stocks are leading us higher. Internationally, we see things like India, things like Japan. I would make the argument that these are developed economies, developed stocks. On one hand, you have Japan. On the other hand, you have India who doesn't have the same accounting standards. I don't really want to get into the fundamentals of everything, but you have some places internationally that are worth paying attention to. At the same time, globally, like if we just take a global index like BEU, which is the all world minus US stocks, and then comparing it to US stocks, still underperforming.
Horrible.
That is a great way to describe it.
And I understand that this has been going on for well over a decade.
Mm-hmm.
And again, it will, like all things do, it will come to an end. But
right now it hasn't. It's right up there with the small cap theme. There was a period post-COVID where small caps were outperforming. We're not seeing that currently. And we covered horizontal levels last week. We talked, episode 190. You want to see something like IWM clear that 200 level. You want to see micro caps. I'll call it clear the 120, 125 level. There are areas domestically that we want to see cleared. The big keep getting bigger. The all-stars continue to be all-stars. The generals continue to do what they do. There always is bearish evidence. And I guess that's where I'd ask you, Ian, is what are the things that you're looking at? We're potentially going out at new all-time highs for the S&P 500, which we haven't seen for 2 years.
Yeah.
What are some things that you're looking at that thesis of new highs leads to further new highs could be broken? What are some areas or ratios or sectors that you're looking at that, hey, here's some evidence we should look at that would be important to pay attention to if that were to fail?
So I think just small caps in general, I would like to have seen them hold up. I'm thankful for the rally they had in, November and December. Wish they would have held up a little bit better. Not that this can't be fixed, but that's really got back. Russell needs to get back up above 2,000. New highs minus new lows has seen quite a drop off as we coast into today. So if we go back to the December 14, that's kind of where new highs versus new lows peaked.
Okay.
And that has continuously that relationship, that ratio, again, highs minus lows, has dwindled downwards for a month now. So maybe a little bit of feeling that as we get up here on the S&P, we're kind of running on fumes. But again, I mean, people can make the argument we ran on fumes all of 2023. So those fumes can be pretty powerful.
When you say fumes being above a high we haven't seen for 2 years, do you mean that from like a breadth perspective?
Yeah, I mean, it's just clearly, I mean, anyone can look at a chart, and this rally to new highs to begin the year has been led by the same stuff that led last year.
Oh, I get what you're saying. So we moved November, December very quickly.
Mm-hmm.
And we get to these, we'll call it, I'm going to use round number, 4,800. We get to 4,800, something like the S&P 500. And we're now experiencing maybe some breadth deterioration. The big are leading, which is fine, but it's still narrow. That's your point, is there's a little bit of fumes here, and we just have to pay attention to important levels, which I guess I would argue is 4,800. If we're back below 4,800, there's probably some evidence starting to build of, hey, is this from a really big picture perspective, a double top?
Could be. You've got bullish percent is back in O's.
Yep, that's a good point. So breadth, that's a good point. If we can't hold 4,800, and I'm not here to say that we could break below 4,800 and hold a 50-day moving average and a volume weighted average price and move higher. Your point is just, hey, it would be nice to see some broadening out at this point. So we're above 4,800 in the S&P. Let's see some broadening out. And if we could use small caps as a proxy, like IWM, how about we just clear 200 on that to confirm that buyers are in control? Is that a fair?
Yeah, I mean, we don't have to small caps don't have to be the best selling product, but do need some people to come in and buy them.
Russell's out of the basement, but we're still trying to have him on this 6-month probationary period where he's got to produce.
Yeah. Sometimes I worry if he's going to pay rent.
Yeah, I get it. He's got to pay rent for 36 months straight for you to have.
He tells me, he's like, Dad, I got it. I got it together. I got a job. I'm getting enough hours. But there's still part of me, where I'm like, he's young. Does he really have it together?
Well, you should have that attitude if you can't get above 200.
Yeah.
If IWM can't get above 200, come on. We're talking about the next. So there's the Russell 1000, which is the 1,000 largest cap stocks, and that's the next 2,000. If little brother can't get it together, we want participation. We want to see expansion. And this comes on the back of a period where, let's be honest about the data. Yes, have we been in an uptrend since we broke out of a basing period? So if you want to call the exact bottom to be October of 2022 for the broad indice like S&P 500,
yeah,
that's fine. But we didn't exceed that range in the S&P 500 till middle of 2023, and we still haven't exceeded from a small cap standpoint.
No.
Can we as technicians say, hey, can we please see some demand that usurps 200 on IWM? Can we please see some demand out of micro caps that exceed a level we haven't seen for quite a while, around, let's call it the 121 level? Yes, we're allowed to have those theses exist that until we're above those levels, sellers have control. Do I think sellers having control is least likely scenario? Currently, I do, but we don't have full confidence in the buyers until we're above certain important levels. And you combine that with an election year that has semi-weak seasonality going into summer. We might not get our answer until summer. And are humans patient, Ian? I don't think so. Show me a patient human, and I'll show you someone that has a microwave in their house. And we might have to wait till summer to have an understanding of, is there enough demand in this market to move things higher? We might not know until then. It might take till June or July to see something like IWM above important levels. And at the same time, these mega cap stocks moving higher. Time will tell. What else, Ian? What else are you seeing? We spent a lot of time equity-wise I know last week we spent a good portion talking about Bitcoin. We don't have to go there. Commodities, we could talk rates, we could talk bonds, we could talk dollar.
Dollar, nice. Still holding up well. Never broke 100. Struggling at 10, we'll call it 103 and a half, 104.
If you're a technician using a trade weighted dollar, we're right here at a 200-day moving average, which currently sits at about a 103 and a half, 103.50. Even above that is some areas that have provided selling in the past around 104. I think if we see the trade weighted dollar above 104, we probably have some equity weakness on our hands. That's probably a likely scenario. Not guaranteed, but it's worth paying attention to that. There's definitely, Ian, would you agree that there's a dynamic between dollar strength and equity strength or equity weakness?
I think so, especially for the small caps.
Yeah.
I mean, the dollar bottomed on, late December, and that's where small caps peaked. So
Good
definitely
point.
a big headwind for them.
It's a good point.
Much more sensitive to that stuff, right? And if you're worried about the dollar, what are the companies that are going to be least affected? Ones with massive cash flows and cash on hand and can withstand any type of currency fluctuations. Your big behemoths
Your multinationals, right?
Your multinationals versus, Mr. Bob's industrial company. I know that's simplistic sounding, but
I feel like
they just don't have the resources that companies worth hundreds of billions of dollars, if not trillions, have.
I do feel like we should name an industrial company Mr. Bob's.
Mr. Bob's Industrial, and then we'll have to IPO it.
Yep. No, I like it. No, but your point is valid. Like your mom and pop, but yet larger company in the U.S., they don't have the ability to hedge or absorb any currency risk.
Most of their products are probably sold domestically.
Yes, right. Whereas like your Apple, right? Your Apple or your Microsoft, they're selling international. That's not a question. Your NVIDIA.
Yeah, they'll just move production to a plant and they're like, we'll just produce X product over here because it's going to save us. And a lot of that comes down to, everything's the same. All inputs are the same besides the currency.
Mm-hmm.
And they can
currency
do that.
matters.
Mr. Bob does not have factories around the world to play the currency and import-export game.
Or the interest rate arbitrage, or, like someone like Japan having a 50-year duration on their sovereign debt versus the U.S. who has a 30-year duration. And here you have an area like Japan moving out to new relative highs versus S&P. Well, some of this does matter. The way you generate credit, the way the interest rates work, they do matter. And they don't have to be all in the same cereal bowl. Like, it's not like Japan has to be married to everything international. It's very obvious when you look at something like VEU versus S&P that's in a downtrend. Yet you look at something like DXJ versus S&P and it's in an uptrend. So that's the power of technical analysis. I get it. Ian, I think of you, you're smarter than me. And unbelievably, there's people smarter than both of us. And for whatever reason, they want to use fundamentals. And fundamentals get restated all the time. Like, look at the job numbers, look at the GDP numbers. You know what doesn't get restated? Is price.
Yeah.
And so here we sit and we've got trends on us internationally that, broadly speaking, internationals in a downtrend versus S&P. You brought up China before, major weighting in EEM, emerging markets. That's in a downtrend. But you look at certain spots, it's not the same. And Japan is one of those unique areas where you're seeing an uptrend on a relative basis.
Yeah.
Last week we talked about the DAX, the German DAX. Huge correlation to S&P, moving higher, not exactly bearish. And this is all happening in the extreme context of Bitcoin sentiment and T-bill sentiment. And we haven't even talked about commodities. What are we seeing out of there? I mean, I think about oil, energy, base metals, industrial metals, agriculture.
Yeah, it's interesting to see energy fall apart when crude itself, it's held up pretty well above 68, 70 bucks.
I think,
it changed the ticker on lumber.
Yeah, lumber. Well, then that goes back to, I think you highlighted this maybe 6 months ago. right? Lumber is going away from the way they measure it has to do with if it's going to be used, like the quantity used per house versus what's on a truckload. I could be getting that wrong, but I know you
Yeah,
highlighted
that
this in the
sounds
past.
right.
Like we're changing how the contract is measured.
Yep.
It's an interesting time because one of the leaders in the market is something like ITB, home construction, versus the S&P. So, okay, we've got semiconductors on a
Home
relative
builders.
basis, home builders. I know you've highlighted industrials in the past.
And they've fallen off a little bit. It's still very much a tech. I mean, what about like Fangs? Fangs, new highs today, new relative highs too.
So that's your big cap tech. So you got your big cap tech, your semiconductors, your home builders. I would even say some ratios that we haven't touched base on is like discretionary versus staples, or even just staples versus S&P. Like, are we buying Clorox or are we buying S&P 500? We're buying S&P 500. That's risk on.
Yeah.
So all the things continue to align for risk on behavior.
Yeah, there's been some pretty healthy, I get, when we got up to 4,800 initially, what was that back in late December? Yeah. And so, any technicians tell you the healthiest thing you can do is consolidate sideways. Obviously, the NASDAQ and the S&P did a little bit better job of that than our friend Russell. But
well, no, I mean, that brings up a good point, Ian, because we moved pretty fast from early November into late December across all indices. And in fact, I think you highlighted that small caps was the fastest we've seen in a long time.
It was a price thrust.
Is it really that bad of a thing to see it react to a horizontal level and consolidate? Now, we don't get to say consolidate until small caps stop going down from that 200 level.
Yeah.
And that's what we've seen, and correct me if I'm wrong, basically since the beginning of January, small caps have pulled back. This is where you kind of want to see them firm up, consolidate, could consolidate into the summer. And this gets into all sorts of human behavior dynamics because who can wait till summer, Ian? Like summer is so long. Like how can we get to summer? But yeah, that would be, if you saw small caps digest and consolidate from now until summer, super beneficial.
A lot of pent up energy. Pent up energy.
That would be a helpful dynamic, very constructive. Do we see that? I have no idea. But as long as we're holding above the volume weighted average price from the November 2021 highs and something like IWM, very constructive. We continue to see the leaders lead. It's not like we're seeing staples lead. You've highlighted that in the past. We're not seeing that. So there's some healthy undertones going on with the market after a really aggressive move November and December. I don't know that we need to be super greedy. It's okay if some of these things are consolidating. What else? So
fair point.
We're up against kind of the end of our time together. I always appreciate this time together. Anything you want to touch base on that we haven't highlighted yet we're talking about?
No, I just think, my big thing was a lot of continuation so far. It's the mega caps, large cap growth. Maybe there's some catch up here, but when you take NASDAQ versus IWM or NASDAQ versus S&P.
Ian, you're a pretty smart dude. Like, would you be surprised in 24 months if NVIDIA is the largest capped name? We continue to see NVIDIA move up the ranks. Taiwan Semiconductors had a huge week this week in response to earnings. Again, we're not an earnings shop. We're not here studying fundamentals, but the price reaction to fundamental matters. And here you see one of the top weightings in something like SMH, a cap weighted representative of semiconductors. That's moving higher. I mean, that's very constructive information, in my opinion.
I can't disagree there. Everything. Now, I can't say everything because obviously we've kind of poo-pooed on Russell.
That's a good point.
When we look at weight of the evidence, clearly pretty overwhelming in one direction right now.
Your point still remains, though, when you're saying with the Russell, is that we could continue to see a 2023 scenario, which is a narrowing. Like we're seeing the larger cap names lead while the small cap laggards, it'd be fine. It doesn't mean it's comfortable. It just means the leaders are leading, and that's perfectly normal. Obviously, if we're being greedy, you'd want to see all stocks participate, and that's okay. Like if they're not above 200 on IWM would be a first point of information on that. But it's really hard to have a bearish scenario with semiconductors leading. I'd be a lot more leery if we saw a ratio like Staples versus the S&P reclaiming prior lows, or something like the Japanese yen versus US dollar reclaiming prior lows. That would be, something worth paying attention to. We haven't touched base on rates, touched some on crypto, probably covered that too much last week, a little bit on commodities, but I don't want to cut you off, but we are up against our time. Anything you want to highlight before we're out of here?
30-year yields back to where they were in October 2022, but pretty big area here. Pretty big area. They've had a nice rally again. Speaking of headwinds for Russell, rates bottomed December 29th with the dollar, and I've seen a nice rally, but are we back up above a 200 moving day on that? I guess we are, yeah. Still coming off an oversold reading. I would assume rates come back down. They've had a big move. I mean, in the grand context, you could see rates consolidate for months or years here. Still with the theme of rates go higher over the next 30 to 40. That there will be periods where, rates are flat if you were to draw a straight line across.
And I think there's some dynamics out there that we'll probably touch base on in upcoming episodes. And that just has to do with, you think of floating rate credit that is very much tied to inflation, how that compares to your aggregate bond complex. You look at your industrial metals, like your DBB.
Yeah.
Breaking down. So you have a deflationary, some would argue a deflationary event taking place with base metals breaking down below important levels. But you got a floating rate exceeding appreciation very temporarily versus AGG, an aggregate bond complex. And so you sit there and go, okay, there may be some inflationary things on the horizon here. I don't know. I'm not here to tell the Fed what to do. I'm not here to tell the market what to do. And that, for some people, is offensive. That the market knows more than I do is a very offensive statement. And I hope our listeners understand that the market does know more than we do, that it's a future discounting mechanism that looks out 6 to 18 months in the future. And it's looking at the prospects of the economy, the cost of the dollar, those type of things in the future. And Ian and I are not here to tell that market what to do, but we are here to use price charts and technical analysis to identify trends. And right now, we're seeing things that are risk-on type behavior with semiconductors, technology, growth that Ian highlighted before. Those things are leading. Staples, not so much. So we have to adhere to those type of rules or information from an investment thesis. So great point on rates. There will be a time to talk about commodities. With that, I guess I want to wrap it up. I know we had a short week with the Martin Luther King shortened weekend this prior week. We appreciate everybody listening. And if you guys like this, if you appreciate the information provided, we ask you to share with others and give us a high ranking on the platform that you like to listen on. That would be very much appreciated. Anything else before we wrap up?
I don't have anything. Just want to wish everyone a great weekend.
Hey, and Ian, good luck to your Chiefs, man. I'm cheering for them. I think it's going to be a great game. Chiefs-Bills.
It should definitely be a good one.
I think it's going to be awesome. So I'm looking forward to that. I hope your team wins. I don't really have a pony or dog in the race, as they say, but I hope your team does very well and is on to the next level. So thanks, Ian, for being on here. We appreciate everyone. Have a great weekend.